and what's happened in the last 12 months, and then I'll go through the outlook for markets as to what we think will happen to the market in the next 12 months and previously, and then we'll go through the performance of the fund over the last 12 months and what we think will happen going forward and what are our big positions going forward. Finally, we've got an update on US Shale because I just basically came back from 2 weeks in the US and spent some time in Houston, and if we have some time at the end, we might go through that. So what I'm going to do now is pass it over to Jeff. He's going to go through the outlook for growth. Yeah.
Thanks, Nick. Yeah, hi. Yeah, as Nick said, I'm just going to spend 10 minutes quickly taking you through the outlook for US growth and I guess global growth, and I'm going to aim to talk for about 10 minutes, and I've got about sort of, I think, 6 or 7 slides, and obviously it's a big subject, and I really just try to keep it to sort of the key things that we are looking for and that are forming our view on growth, the growth outlook. And I think the best place to start is slide 4, which the bar charts there will show you the Fed balance sheet. So clearly, since the GFC, we've had a simply unprecedented expansion in the Fed balance sheet as they've embarked on QE, and over $2 trillion now and counting of expansion. And I guess that's clearly been good for equities, but so far the handoff to growth has been quite disappointing and unsatisfactory. And you can see there the lines there represent the consensus forecast for growth in each of those years. So you can see pretty much in each of the last 4 years, the market started out expecting growth of sort of 3% plus, and every single year it's been disappointing. And whilst there's been some exogenous factors, most recently, for example, in 2014, where we started again with expectations of about 3%, we've just recently had quite significant downgrades to the GDP forecast for this year, really driven by the exceptional winter weather we had in the first quarter. And indeed, the first quarter GDP was quite a shocking minus 2.9% year on year. So really we are now at a point in time, quite a critical point in time, where it's really show time for growth. In other words, we've had all the stimulus, and I think it's now quite important that that we do actually start to see the growth. And 2015, again, expectations are for 3% plus, and I guess, dare I say it, we think for the first time, we do think that the growth will probably start to come through quite strongly, and we'd expect a moderate acceleration in growth going forward. And I guess the reason for our optimism, if you go on to the second slide, slide 5, in the first instance, just the global PMIs and the ISMs in the US, and clearly, notwithstanding, as I say, a very poor first quarter, we've had a very aggressive acceleration in the US ISM numbers. The most recent number was, again, 55.4, and I guess within that, and that, by the way, came out last night. And the standout for the June ISM number in the US was the new orders number, which was 58, again, a sort of a recent high for that data series. So basically all the other data that's coming out of the US, which is more forward-looking, is suggesting a far stronger picture for growth. Elsewhere, I guess growth is probably muddling along. I'd probably just call out 2 things. One is the strength in the UK, which really is seeing quite an extraordinary recovery. I'd also call out China, which again has probably defied the bears and is coming through with quite good growth, and the ISMs are all sort of consistently above 50. Europe is sort of muddling along. But if you go on to slide 6, and again, sort of just a further reason for our optimism is clearly the labour market, which has been a big focus for everyone, including the Federal Reserve. On the left-hand side, I've just tracked the non-farm payroll numbers in absolute terms. So if you look at all the recessions post the Second World War, and you can see that typically from the time that the economy goes into recession to the time that all the jobs are recovered, it's been more or less around the sort of 20 to 24 months, sort of been a 2 to 3, at most a 3-year process. And you can see here that the significant point that we reached with the last non-farm payroll number was, for the very first time, we've now in the US recovered all the jobs lost in the GFC. So it's been a very extraordinarily long and difficult recovery, but we are now at a point where all the further growth in the non-farm payroll numbers now net additions to the payroll. And you can see on the right-hand side that the non-farm payroll numbers generating, certainly in the last 4 months, has averaged over 200,000 per month of additions, and we get the next number on Thursday night, tomorrow night, and again we would expect another sort of 200,000 plus numbers. So the labour market is also starting to show real signs of recovery, and basically this is a view shared by the market, and I guess expectations for growth in the last little while have been rising, and with that I think some expectations for short-term interest rates have also been rising, and I'll come back to that in a moment. But if you go on to slide 7, the other key thing I think to appreciate that's been going on in the last 6 months is really this whole debate that's about what the long-term neutral rate for the Fed funds is. In other words, where ultimately are the Fed funds rate going to go? If we are indeed at the start of another rate cycle, what is the neutral rate? And this debate has been led in the main by PIMCO rather publicly, with their they've coined the phrase the new normal, and more recently the new neutral. But also I think it's gained some credence within various members of the Federal Reserve. And really the key point here is to say that because of there's still very, very high levels of debt in the system, and I've just shown you on the left-hand side the two charts there, public debt as a percentage of GDP, which sort of 5 years on from the GFC is still rising as a percentage of GDP in the US, and the bottom US household debt, and whilst that has fallen as a percentage of GDP, in nominal terms is actually still rising, and is still certainly very, very elevated from a historical perspective. And really the argument goes, because of these very high levels of debt in the system, the growth rates structurally will be lower over the medium to long term, and as a consequence interest rates will also settle at a much lower rate. So on the right hand side there you can see that short-term interest rates have averaged between 4.2 and 4.8% since 1857, and the view really is that basically the neutral rate will be significantly lower than this going forward, and that's important because obviously it sets the price for pretty much every financial asset in the world, and if that's going to be lower, it does lend support to bond markets, but clearly also to equities. And so putting that, going forward to slide 8, and this is again something that we watch very, very closely, and this is just to describe what you're all looking at here. This is every Fed meeting they publish. Every member of the Federal Reserve will vote on where they think interest rates will be at the end of 2014, 2015, and 2016, and then they'll also give an estimate of where they think long-run interest rates will be. And what we do at K2 is we track that very, very closely, and as indeed I think the market does. And you can see the table there sort of gives you the median estimates at the December meeting, the March meeting, and the June meeting. And I think the significant points are that because of the increased confidence, as I've just said, in short-term growth, the expectations for short-term interest rates have actually been rising, but at the same time, and perhaps quite perversely, the long-term expectations have actually been falling. So you've had the situation where the yield curve is actually flattening, and this has had quite big implications, and we would argue is quite a big reason why you've seen this quite aggressive rotation in sectors and stocks in the last 6 months, and clearly the market is quite preoccupied with this as we really move towards the first rate hike, which we'd expect sometime next year. And I guess then, I guess the one final thing I'd say is that, in terms of, clearly we're moving from 0% interest rates to 25 basis points, which in itself is very small, and as long as interest rates are going up for the right reasons, i.e. growth is returning, we see no reason why the positive correlation between equities and rates can't continue, i.e. markets can continue to perform quite well over the medium term in a rising rate market, as long as I say, rates are rising for the right reason, that growth is returning. And I think that the key risk, however, is that at some point the Fed's hand gets forced, i.e. they are forced to raise rates either sooner or more aggressively than the market would like, or was warranted by the economy. And I guess the two reasons that potentially could happen is one, in the first instance, inflation. If inflation starts to become unanchored, and on slide 9 I've given you the 2-year break-even rate, which is sort of the market's estimate of inflation. You can see there that it still remains very well anchored. And on the right-hand side I've given you the US average hourly earnings, which I'd suggest is probably the key figure to watch in the short term. And again, you're going to get this figure on Thursday. At the moment, the year-on-year change has been about 2.1%, and anything around that I think will be quite benign. I think if that data series does start to break out, I think that would be something you'd need to watch quite clearly. But as I say, at the moment, there's no sign of that. And then on slide 10, just to finish off on this, is credit markets. I guess, if credit markets do start to overheat as people overreach for yield, and there's been some evidence or small evidence of this in the UK, where the Bank of England recently came out and said interest rates could rise sooner than the market expects because of their concerns about overheating or over-exuberance in the housing market. And here again, from our perspective, there's no red lights flashing. I mean, there's maybe a few amber lights. I mean, corporate bond spreads are close to their sort of post-GFC or at their post-GFC lows and close to their pre-GFC lows, and things like covenant-light loan issuance is starting to pick up. So clearly there's some amber lights here, but I think we need to watch that quite clearly, and that may also potentially down the line force the Fed's hand. But that's, I think, all I would want to say about growth at the moment. So essentially we are quite constructive.
Okay, so just bringing that back into markets, because obviously growth and markets are two different things. And at this point in time, I'm on slide 12, and what we're saying, what I'm showing you here is just that risk metrics continue to compress. So essentially 5 years into the bull market, and 3 years post the European issue, we have essentially Spanish bond yields trading, below US bond yields. We have the VIX in the US trading at a monthly all-time low. We have corporate bond drunk spreads trading at very low levels. So you've had this huge compression in all the risk metrics around the world, basically, but over the last 5 years, but particularly in the last 3. And so what's essentially happened with that compression of risk metrics is you've had a very strong performing market over 3 years. What I'm showing you on the left slide is the forward EPS of the US and the forward PE of the US S&P 500. And as you can see, EPS has been growing sort of gradually since 2011 and strongly since 2009, but the big change in the last 3 years has been the market re-rating from the lows of the European crisis back to essentially a multiple that we saw pre the crisis. And that's meant a very strong performance in the market over the last 3 year period, and one that we have tried to capture. In terms of what that does for the carry, and so as I said previously, this market has performed well and it is looking somewhat mature. On the flip side, the equity carry still works because rates are so low, and I've shown this chart lots of times before. The difference between the earnings yield in the US and the US 10-year bond yield means that equities, particularly in the US, but also elsewhere around the world, can borrow money at very cheap rates, as we're showing you on the right-hand side, and reinvest it in either capital investment projects that deliver higher returns, or reinvest it in buybacks that also deliver higher returns, or paying down debt. And so from that point of view, the equity carry still continues. While it has shrunk through this market re-rating, it is still not anything like what it was previously. And so from that point of view, if rates stay low, the environment for equities can still continue to be good, despite the fact that the market has done so well recently. We're showing this in another way here. The corporates continue to take advantage of this carry. All we're showing you here is the S&P non-financial cash on the balance sheet, which is a lot, and the aggregate share repurchases. So the buybacks are obviously continuing at speed, as too is the M&A activity now on the bottom, and we're seeing a lot of deals cross-border to take advantage of things like tax inversion in the UK, etc., etc. So again, corporates are recognising that the low interest rate environment is here, maybe not be here forever, and so they are keen to take advantage of it, and that is helping the market at the moment. Finally, just something that Jeff mentioned that has changed significantly in the second 6 months of this year is that the yield curve has started to flatten. So all I'm showing you here is the 10-year to 2-year spread since the start of the year, and obviously going back further. And the curve is flattening basically because people are starting to see the first rate hike. And as you see that first rate hike, then generally markets stop re-rating into rising interest rates. And so what we'd expect is that the re-rating for the equity market is essentially finished, even though the carry is there, and that markets essentially have to track earnings growth from here. What that also did in terms of the rate hike expectations meant that we saw this quite aggressive rotation in the first half of this year, whereby the growth stocks that essentially had quite a bit of multiple in them lost a lot of that multiple, and the value stocks outperformed. And we saw that particularly between large cap and mid cap. I'm showing you there in the US, but it also happened in the UK. That's not surprising as we enter this first rate hike period, but it was definitely something that we missed. Okay, so moving on to the portfolio update. So just to summarise, our outlook for growth is that growth is going to get better in the US and should continue elsewhere in the world at a sub-trend to slightly above sub-trend place. Unfortunately, that does mean that interest rates are going to have to rise at some point, and that will probably happen in the UK first and maybe the US second. And we've already seen the first signs of that with the UK starting to threaten to hike rates sooner than people think, and eventually that's going to happen in the US. That makes portfolio management a little bit more difficult because you are dealing with essentially re-ratings and de-ratings, and we have seen a lot of that, particularly in the second half of this year. From our point of view, we need to hold our view through this, and so now I'll give you a quick portfolio update as to how we're going to run the portfolio going forward and how we have run it. So as you know, we have three tools here at K2 that we can use. One is the ability to pick stocks, one is the ability to be in and out of the market, and one is the ability to hedge or unhedge the currency. If we look at those tools year to date, the one thing that we have done so far this year is I'm showing you the net market exposure of the K2 fund since inception and the short exposure at the bottom. And the one thing we did do in essentially March is we reduced exposure roughly to 80%. So we essentially got nervous on markets into the seasonally weak period, and we got nervous as we moved into the rate hike cycle. Ultimately, that was essentially right in the stocks that we held, but unfortunately the market essentially rotated that liquidity into other parts of the market that continued to do well. And so I don't think after 5 years of a bull market that being somewhat slightly more cautious is the wrong thing to be doing. And I do think it does make sense to be slightly more cautious 5 years into a maturing bull market. But from at least a relative point of view, that move did cost us somewhat because the US market continued to power on through what we expect to be a volatile period. The second thing to highlight is on the currency. The currency, we have moved from a hedged position to a predominantly unhedged position. That benefited the fund in the first half of the year, and it has cost the fund in the second half of the year. The Aussie dollar has rallied significantly, roughly 6% since the start of the year, and unfortunately we have worn all of those losses. So relatively that hasn't hurt us, but at least in an absolute sense it has cost us some performance in the Select Fund in particular. The reason why we're unhedged the currency is because ultimately we believe in a strong US dollar. We're unhedged the currency because we believe that US economic growth will get better, and there's every sign to suggest that's happening. We also believe that US interest rates will essentially rise versus Australian interest rates, and so that will take away the yield carry, which should lead to a strong dollar versus the Aussie dollar. And what we're showing you here is the spread of the Aussie 10-year bond versus the US 10-year bond, and what you can see is that the spread is now as low as it's been for the best part of 8 years, and it's as low as it was back in June last year when the Aussie dollar was much lower. But the Aussie dollar is not basically falling in line with the compression in yield spreads. And we would argue that the compression in yield spreads is a good indicator of the economic growth of the two countries, but the dollar is not following. That, to be clear, is perplexing us at the moment, and it's something we need to watch closely because ultimately we're not in the business of losing a lot of money on the currency. So at some point we may have to exit this position, but for now we still firmly believe that the US dollar should be stronger in this environment, and the Australian dollar strength is something that is concerning. Just in terms of performance of the fund, as I said, we have the three tools available here, the ability to pick stocks, the ability to move the capital, and the ability to move FX. And what you can see over the length of the fund, that all three of those tools have added value. That's what I'm showing on the left-hand side. On the right-hand side, I'm showing you just the last 2 years, and it is important to flag that as the bull market matures and as the bull market continues, it is increasingly hard for us to keep up with the strength of the market. That's partly due to the fact that we don't invest all our capital. That's partly due to the fact that we won't completely unhedge the currency over the last 2 years as it fell. And then most recently, in the last 6 months, our stock performance, which normally makes up for the other two, has let us down definitely in the last 6 months. And that's caused this essential drag versus the index. This, to be clear, is something that always happens in our funds at this point in the cycle. We had a similar issue in 06 and 07. whereby the market performance gets so strong that we start to lag. But ultimately, we have these tools available, and they're very useful when the market direction changes, and the relative performance can swing around very, very quickly. And we've seen that in the past, and we'd expect to be able to use these tools aggressively in the future. But to be clear, you can't outperform a falling currency, and you can't outperform a market that goes up one way with two of our tools. So the ultimate tool is to use our stocks. And up until recently, that had been quite good, but obviously the last 6 months hasn't been as well. So let's just talk about the stocks quickly. This is the performance of the fund financial year to date. This is where we got the performance in terms of stocks and regionally. And as you can see, most of our major positions generated good positive returns. Google, United Rentals, Disney, Lyondell, you would have heard us talk about these stocks in the past. They've been in the top 10 for some time, and most of them are still in the top 10. Things that we banked were the Macau positions, which we banked quite well, and we also banked our position in Whirlpool. So both of those are no longer in the fund. Regionally, most of our performance came for the US, which would make sense. The disappointing things there has been any money we had in the UK. The UK has been very disappointing for us. We haven't lost money there, it just hasn't made any money. And Japan has been somewhat disappointing. Importantly, at the bottom there is no single position that lost us more than 35 basis points in the fund this year. So there are a number of stocks there that clearly we shouldn't have bought. But none of them, and most of them, were exited before they became a difficult position in the fund. And to be clear, all of the relative underperformance that you've seen in the last 6 months has been effectively a case of stuff we didn't own rather than the stuff we did own. And so what we've seen is a strong performance from things like integrated oil, a strong performance from pharmaceuticals, strong performance from utilities that are all sectors that we hadn't played in. And this is partly due to that rotation I spoke about earlier, and partly due to a lot of our stocks just taking a pause. And so just to run through some of that very quickly, and I'm just talking about calendar year to date here, not financial year to date. All I'm showing you is Google and Comcast, the two biggest positions in the fund. Long term, we think these companies, if you look at the bottom on the 5-year charts, are long-term structural winners. We've liked them for a long period of time, and we think they continue to win. Calendar year to date, they've mainly tread water, partly because a bit of multiples come out, and partly because of acquisition issues with Comcast. But ultimately, we believe stock prices track earnings growth. Earnings growth in these companies is assured, and ultimately you can re-rate and derate for a certain period of time, but in the end the share price will always follow the earnings, and in this case we strongly believe the earnings growth is intact for both these positions. To be clear, some of the stuff we did get wrong, and the big thing we've got wrong in the last 6 months is the UK. We did have a position on UK housing through Rightmove and Countrywide, but also through Barrett and Lloyds, and we were wrong-footed by the Bank of England moving towards rate hikes quicker than we thought, and also flagging a housing bubble. And to be honest, part of this is political. We're somewhat surprised that they bring in a Help to Buy housing stimulus program in October of 2013, and by April of 2014 we're having an active debate as to whether there's a housing bubble in the UK. To be clear, house prices in the UK are still below, on the whole, below where they were in 2008, and housing activity is 80% below its previous peak. But ultimately we can't fight the Bank of England on this. If they think there's a housing problem, then unfortunately these stocks are not going to perform, and so in many cases these stocks have had to exit the fund due to our stop-loss criteria, and also due to the fact that we have to accept that UK growth is very strong, the UK recovery is very strong, but the UK interest rate environment is going to be problematic, and this is something we need to be aware of globally going forward. And to be clear, there's also plenty of stuff we got right. I'm showing you here a couple of our US shale trades. LyondellBasell is a chemical company in the Gulf of Mexico. United Rentals is an equipment rental companies in the US. Both stocks have done very well as US growth's continued, particularly the US shale growth. They've been good to us this year, and they've been good to us over a long period of time, and we'd expect them to continue. It's not surprising, I suppose, in hindsight, that they've done well. Both stocks are on 12 times forward earnings into an accelerating US growth outlook. But to be clear, most of our UK trades are also on 12 times earnings, but they're moving into an accelerating UK growth outlook, but obviously a problematic interest rate outlook. And that's the difficulty that we have in this environment at the moment. As it stands today, here's the top 10. Basically, 6 of the top 10 are exactly the same as what we have probably shown you previously. There has been some rebalancing somewhat, so we have reduced the size of the bet in Google and reduced Comcast slightly. We've added things like National Oil Varco, which we think is a very interesting or a very good US equipment provider. perfectly leveraged to the US shale boom and also perfectly leveraged to the growth in oil and gas. Stocks on 12 times forward earnings with a 3% dividend yield. We've also added Sanofi, which is a French pharmaceutical provider specialising in diabetes, again on 13 times earnings with a 3% dividend yield. And aside from that, we still hold the positions in Rightmove and Eurofins, and the last one we've added is Skyworks Solutions at the bottom, which is essentially a play on the Internet of Things through radio frequency devices, and they essentially create antennas for both wireless and Wi-Fi devices. As we said at the start, this is a stock picking strategy and a pragmatic strategy into how we approach the market. And so to summarise, the market from our point of view, we knew this year was going to be difficult because we moved into the rate hike window. It has proved difficult, but difficult more in a relative sense than an absolute sense, as in the market has stayed strong while we have been somewhat defensive. From that point of view, we do ultimately feel that the market can work through this period. And from our point of view, from a stock selection point of view, we need to be vigilant. Ultimately, we believe stocks track earnings growth. Ultimately, we strongly believe in the earnings growth environment in all of these stocks because they're leveraged to all of the secular and structural growth dynamics that we see in the world today. And so ultimately, we believe the stock performance will improve over the coming 6 months, similar to it was in the first 6 months up until Christmas. I think I'll leave it there and take some time for some questions. We have some added stuff on Shale that we can talk to about the end, but I'm happy to take some questions here at this point in time. Okay, so we've got the first questions from Clayton. Can you explain the K2 disciplines that occur when you've discovered you've got a stock or position wrong? So to be clear, we do have a stop-loss criteria in all of the funds. The stop-loss criteria has been in existence since 2001 and has served us very well over a long period of time. The stop-loss criteria basically says that it's a portfolio position and the position has fallen 20% from peak or 20% from cost, then we have to exit the position. If it is a trade position and it's fallen after 30 days, we have to exit position. To give you an example, I think we've had 3 major stocks trigger in the last 12 months that were large positions for us. One was a Japanese bank, SMFG, which we triggered out of early, and that actually saves us quite a lot of money. The second one was also triggered, and then finally was finally was Barratt Development, which was also a UK housing play. The important thing here is to be liquid, obviously. It's no point having stop losses in place if you're running $20 billion worth of money and you can't exit the position. So liquidity definitely helps us here in these positions, and that's what we've done over the last 12 months, and that's what we'll continue to do going forward. From our point of view, we will always make mistakes, and obviously recently we have made mistakes, and these processes are in place to make sure that those mistakes don't cost us in the long run. Ultimately, the process that we've been following has worked well for the best part of 10 years. The funds here have been in existence for 10 years and 15 years for the other products, and ultimately they've worked through all cycles, and so if we continue to stick to our processes, we'll continue to get more stocks right than wrong, and the wrong stocks the triggers will take care of. Still waiting out there if there's any other questions. Happy to take some more at this stage. Okay, so in the absence of other questions, and please pile them in if you want to, the only last thing we wanted to flag was, if you go to the next slide, that we have essentially just got back from, I'll do the conclusion in a second. So yeah, the only other thing we wanted to flag is, if you just go to the next slide, is we just spent essentially 2 weeks in the US looking at the US shale story, which has been a good performer for a period of time and we expect it to continue. The one thing I'd just flag here is that the transformation here in the US is something that even the people in the US haven't got their heads around. And I'm just going to flag 3 slides here very quickly and a couple of stocks at the end. Firstly, the slide on the left here just shows oil production in the US and natural gas production. As you can see, oil production in the US has gone from 11 million barrels down to 7 million barrels and then reversed back to 10 million barrels in the space of 3 years. That's essentially unheard of in US oil, in oil and gas globally, to be able to reverse your production decline that quickly. The second thing to flag is that is all finding its way out of the US in terms of exports, in terms of LPG, gasoline, distillates. because there's currently an export ban on crude, so it has to find its way out of the US in other products. What we're going to see going forward is you are going to see this US crude export ban slowly lifted, and that's going to have some profound implications for these US producers. And if, from what we discovered from going to see companies like Anadarko and Exxon and others in Houston, ultimately these guys think they've got, you know, between 50, 40, 95, even 110 years worth of drilling inventory in these regions around the US, all of it based around the shale technology. A lot of that is in gas, but a lot of that is in oil. So essentially the size of the reserves in gas in particular is almost limitless, and in oil is very, very large. And so the problem has been infrastructure and exporting. And so from that point of view, as the export ban gets lifted and as the infrastructure gets built, we expect the US crude differentials to close with Brent. And then the final best part of the equation is now with the problems in the Middle East, we basically have a crude price that's essentially going to hold up all the supply, mainly because Libya is out of the market, now Iraq is out of the market. So from our point of view, US upstream companies, which have been suffering from weak gas prices and weak oil prices, now look very well positioned. And to be honest, we have been slow to this. This has actually been happening for the last 3 to 6 months. The service providers also look very good because the US is going to move into a period of manufacturing oil and gas for the world rather than the boom bust that had been previously, and the boom bust was basically because of infrastructure constraints. The final thing to flag on this trade is that downstream there is some very big winners in terms of refineries, mainly around the Gulf Coast, that can process these products and export them, and secondly the midstream winners also, in terms of the people who own the terminals, who own the export facilities, who own the pipes. And then the final way we played it, and I flagged this earlier, is through United Rentals. The construction winners, which is essentially United Rentals, Ashtead Group, and others down here. And so from that point of view, all of these companies are not necessarily expensive. All of them are leveraged to a multi-year trend. And from a construction point of view, it's worth flagging that in the Gulf of Mexico, there's no such thing as essentially endangered turtles, etc., because from that point of view, they really do have an open runway to make this construction go for the next 5 to 10 years. And so from that point of view, we'd expect that window to stay open for a considerable period of time. The two stocks that are big positions in the fund, but there are obviously others that are smaller, and I'll let you read the details themselves, are Lyondell and National Oil Varco. Lyondell is a basic petrochemical producer in the Gulf with a significant cost advantage in terms of ethane and a significant cost advantage versus other chemical companies in the world, and they will continue to benefit from that and buy back stock and return cash to shareholders. Varco is essentially the largest producer of land rigs in the world, chop drives and drilling equipment. So they will benefit not only from the US moving into a manufacturing side, but also from the rest of the world essentially trying to catch up. And again, neither of these stocks are very expensive, so we like them over a long period of time. In terms of, that's essentially where we are on the Shale situation. In terms of questions, we do have a couple more questions here, so I suppose I'll just roll into those. The first question is from Martis. Can you explain how the fund lost an absolute 8% in the last 6 months when you have levers to manage the downside? And I think that's a very good question. I would flag that basically if you go through the 8%, 5.5% was the currency. And so the currency has rallied significantly since the turn of the year. And so we have this situation in the fund, and it is worth being very clear about. We had basically a 6 months where everything went right, and we crossed the December year with the currency weakening, significant amount of stock alpha, and we've been fully exposed. And then the second 6 months, we've essentially had the currency go down. The currency go up, so we've lost 5.5% on the currency, and we've lost around 250 bips on stocks. So the actual price losses are actually not that high. And as I said at the very start, you know, there's no single position or in the presentation, there's no single position that's lost more than 35 basis points. It's essentially been a relative issue. It's either things we haven't held rather than things we held. And in terms of the vast majority of our stocks, none of them have actually lost that much money. And so from that point of view, the triggers are there to manage the downside, but essentially it is a relative situation. The other thing to flag is obviously the fund is now below its high watermark because we essentially took fees in December. And so when you are below high watermark, we are now essentially, the 8% that we make back is essentially coming no fees, or sorry, no performance fees, just management fees to make back from here. So it is a situation of essentially the straight up and straight down. The currency is the main issue, and I did mention that it is concerning to us. We don't like losing money on currency. it's an area where you can lose a lot of money quite quickly, and it's not something we like to do. But obviously we have to balance people's relative performance aspirations versus their absolute performance aspirations. And currently we believe the currency will continue to fall eventually, and that's why we've got an unhedged position. But ultimately, yes, we may have to stop ourselves out of that view. I'll just pause for a bit longer to check if there's any questions, otherwise I'll wrap up. Okay, so to conclude, the financial year was a positive year of returns to the fund, but it was somewhat disappointing considering the exposure we had on the market performance. As I said, we had a very good first half and, to be honest, a disappointing last 6 months. On the capital exposure in the fund, we're 5 years into the bull market, and with rates set to rise in the next 6 to 12 months, we do see some reason to be slightly more cautious going forward, and I don't think that's worth apologising for at this point in time. I think we've run with the bulls for as long as we can, and from that point of view, it does get more dangerous to run with them from here. On FX, we remain unhedged, and we look for the currency to weaken over the medium term. Over the longer term, we have the ability to hedge the currency once the depreciation is complete, and obviously that's something we have to assess in the short term. Look, on stocks, while we've achieved an absolute return on our investment, recent relative returns versus the market have been disappointing. We're more than happy to admit that. But look, honestly, we remain confident with the earnings growth of our investments, and while styles can re-rate and de-rate over any period, ultimately we expect the share prices to track earnings growth over the long term, and consequently we remain confident in the outlook for our current investments. We're obviously available for any further discussions for stuff that you haven't been able to bring up on the call, and any feedback you've got on this would be really helpful because we obviously want to improve it going forward. And we'll leave it there. Thanks very much for your time.
So thanks very much for attending. As Nick said at the start, this is going to be an ongoing feature of the K2 International process. The webinar this morning was recorded, so I'll put that up online and send the link out to everyone post the meeting. And if you have any questions or feedback, would be greatly encouraged. So we'll leave it there, and thanks very much for your time.